Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good afternoon, folks. It is 12:30 here on the East Coast, September 6th. First full trading week, I guess, of September. A little bit different here, and apologies for being late. I got my wires crossed on my end. I was just sitting here looking at S&P and some other components, and all of a sudden I looked down and it's 12:30. So apologies for a bit of a delay because I meant for this to get going. I'm basically late to my own show. 15 minutes late to my own show. But that, this is okay. A little bit different one today. We're kind of mixing it up. Normally this is how these weekly notebook reviews happen after market close, but I kind of figured I'd mix it up a little bit and do during market hours, lunchtime here. And yeah, so we got, I see some good friends of the program out there. Mr. Loftus, Mr. Pastiglia joined. So if you guys want to jump up and chat or share kind of what you're seeing in the markets, happy to have you guys up here. We'll kind of get going. Just a couple key things, I guess, this morning in terms of some big takeaways. Keith turned that free red eye, green eye app that we've talked about a number of times. He turned that to snooze and bear. So that's the Thunder Bay Bear. He's basically, what he wrote this in an RTA, but when you see that, it's basically, he's just kind of covering some of his shorts, right? So he's just kind of waiting to see, what the market does and where he might be able to put those shorts back on, right? So just kind of keep that in mind. We're almost down a little over 1% on the S&P as we head into our midday session here. And yeah, so I think from a tier one alpha standpoint, that lower band, we're kind of right on it in regards to their PV band. That is not, that's not our risk range, but that is their PV band. It was around, I think 4450 was the level today. Let me just double check that. 4451, excuse me. So 4451 was the low end of their risk range. 4355 is our immediate term low end of the risk range. So we still do have ways to go in order to get to the low end of that range there on our side in regards to the risk range that you'll get in the risk range product. I think that's an interesting one and a call that I wanted to make because although Keith is put that red eye green eye out to neutral, I think it's a telling sign where we do have almost a little over 2% downside. And he's kind of just getting a little bit, I won't say defensive, but just sort of, it's payday, right? So it's always good to pay yourself. You're never going to lose sleep over putting extra cash in the bank and all that kind of stuff. So whether you trade on a shorter term duration or more of a longer term duration and both, so see, as I said, Pastiglia and Michael Loftus are both investment advisors and run their own RIAs. So, typically, they'll have a bit more of a longer term outlook. But if you made right decisions at the right times, and not just on the S&P, but for instance, on maybe fading some of the rate moves, right? Whether you put on SJB, which would be a short junk bonds ETF. So we were certainly shorting high yield last week as rates moved to the low end of their risk range, and then popped since then. So we're up at the 4.30 on the 10-year and 5.027 on the 2-year. So again, these things, it's all kind of intertwined. The dollar move has been obviously a really important one as well. And I got to give my guy X2 DA4 out there a big shout out. The last time we had this notebook review, which was 2 weeks ago. So appreciate the kind of patience during a little late summer hiatus, but the batteries have been recharged here by this guy. And one of the things that he brought up was sort of, what's a trade that if you didn't make, you really need to go back and review sort of your process or the decisions around that. And to me, in the last 2 weeks, it was the oil trade. So if you kind of pull up a chart on crude oil, it sort of had that pullback back to, what was it, kind of the 70, high 70s, 78, 79 range, around that August 23rd, 24th, 25th level, and really sort of held, right? So it held, it kind of had that pullback over the course of sort of a week and a half, 2 week period, and then held. So if you kind of didn't, and Keith kind of added it actually on that Monday, the 28th, I think he was adding some to XLE, if memory serves, in the Mucker Family Office account. So, if you kind of, if you were proactive there and added on that sort of red day, or once it sort of found its footing kind of in the kind of high 79 range, that was a great move, and that was certainly a trade that you should have been making. Today's session is all about kind of stagflation and the quad 3 environment that we find ourselves in at the moment. And from a stagflationary standpoint, you got inflation really moving higher, right, and growth lower. So getting longer of components, different components of energy, whether it be uranium, XLE, XOP, precious metals is one that we've been adding to as well. And silver got added to the board this week as well. So kind of some of these commodity and CRB complex is a really good place to be putting your cash to work. But at the same time, I think that oil trade was really one or the energy trade in general was one that was right there, and that's following the full cycles, because if you go back to the tapes, we added energy, I think, kind of some oil exposures around early to late July. So really kind of the start of the Q3 period, as Keith alluded to in the early look this morning. And it didn't really give you a whole lot of opportunity, certainly if you kind of just pull up the crude oil futures chart, CL1, until this most recent pullback in late August. So that was, if you quote unquote missed that run, to use the more common terminology, that's a place where you could have been adding to it and taking advantage of sort of an opportunity. So again, I think I just want to kind of call that out and make sure that everybody within Hedgeye Nation kind of either reevaluates their exposure to the energy complex, and or reevaluates kind of what they did in late August there, going into post that sort of that pullback. So I'm going to call up Loftus. A lot of friendly faces, and I'm going to let Loftus, George, you jump up to Bud, Pistilli, you still in the crowd? There you are. Perfect. So going to invite a few guys up here. We can keep kind of running through the gamut, but again, we've talked a lot the last couple of months about, felt like a broken record in regards to, the correlation and or the importance of tracking the dollar volatility rates complex, and really has volatility across the board, whether it be the VIX, the VIXN, the MOVE index, which finds itself back up close to 110, and as well as from a commodity standpoint, the OVX and GBZ as well. So that'd be OVX for crude oil and GBZ for gold. So how are those all interacting? I think the interesting component and the big change from 2 weeks ago on the VIX, which had been up at call it kind of that 18 range before I took a little bit of holiday, or call it mid 17, 16 range when it kind of made that move. We're now back under 15, although today it's been a pretty significant move in the VIX, and that is an interesting dynamic, right? So over the course of the last 2 week period, vol suppression has occurred. Who really cares why it happens or what's causing it? Or I've seen a few kind of tweets out there, or I guess maybe posts, to use the proper X terminology. Some posts in regards to, okay, are you looking at the VIX or the VX? 30-day VIX doesn't really matter anymore. And again, to give Chris Moyer at 1000RFX a massive shout out, to sort of, I certainly incorporate the VIX 90 and the VIX 1D on my screen. And if you, the global macro watch list is available for anybody to have on TradingView. I make that. I think you can just grab it off of my profile. But if you can't find it, then please just DM me and I'll make sure you get it. But my point is that all this should be part of your process, right? Looking at the 30-day, even the 3 months, the 9-day, the 1 day in regards to VIX, and how are they kind of intertwined with each other. And again, you're seeing a pop here in the VIX, but we're still sub 15. And, could that be something, we're seeing some lower highs in regards to the top end of the risk range on that VIX. And therefore, what's, on an immediate term basis, that's sort of driving, so that's likely driving some decision making from Keith, seeing that top end come in from a week or so ago, from the kind of like 18 range down to 17.88 today. It is neutral. It is a neutral trend at the moment, and then that low end of the risk range down at 13.03 on the VIX. So that would be that 13.03 would be a new and a recent low. I believe that closing low was 13.08 from Friday, from September 1st. So that 13.03 is important, and the fact that it is a kind of would put in a one. I think that's a 1 month. Let me just add that indicator real quick. Don't always have it on. So that would be so if we could get down to the bottom of the risk range, which would be below Friday's close, you would get you get a new 1 month low. And that 3 month low is down at 12.90. So not very far below that 13.03 number from the low end of the risk range today. So again, all these things, it's a complicated game, but sort of tracking or kind of having a way to just sort of navigate the nuances of the global markets is really important. So the dollar itself, Keith's been kind of begging or talking about this on the macro show, certainly this week and really the last few weeks, but harping on mainstream media in regards to the dollar being dead back in July, late July, to where we are today, and it's breaking out to new 1 month and 3 month highs. So big kind of change there in the dollar. It's been a great place to have your assets. And again, think about it. You don't necessarily have to have UUP on in your portfolio. If you're holding cash, here in the US, you're holding US dollars regardless. So therefore, again, that is an asset allocation. That is a decision that you're making. How much cash do you have at hand? How are you deploying that cash? Are you putting it in T-bills like Keith did last week, going into month end so he can get that dividend check? Are you putting it in something of his equivalent of the FDRXX, right, to get that 5% kind of money market aggregate interest rate over the course of the month, right? So what are you doing with the cash? That's a decision for you to make. I know George, who also runs an RA, he is a big fan of BFIX for a while, and I think that's another potential place to be putting your cash, right? So that's an interest rate hedge, and it's certainly been a great performer over the course of the last 2 months or since kind of late July, and again that also does pay a little bit of a dividend, not a big one, but certainly it does pay out 10 cents on an $80 stock or ETF. So just keeping all that in mind, I think that is really important to understand kind of, what you're doing with your cash and cash decisions that you're making. They don't necessarily, again, as I said, they don't necessarily have to be in a UUP. But if you're holding US dollars, you have that allocation. But then can you try to maximize that allocation? The shorter end, as I said, Keith went with T-bill. You could go into, treasuries themselves, whether it be, 1, 3 months, 6 months treasuries. You can do that from Treasury Direct. That was kind of, I think, a question that I saw up on Twitter in the last week or so. Somebody asked, how do you get rate exposure, or how do you buy, treasuries? And so the main thing is, you can do that through Treasury Direct. Again, this is not investment advice, but just to help you out, you can do it through Treasury Direct. And you can buy those shorter end of the yield curve, so that if you don't want to, just buy T-bill and stuff like that. Just wanted to kind of touch base there. The rates environment, and certainly this inflation that we're seeing in the last month, And again, just as a reminder, I think we touched base on this on the macro show last week, but that CPI number that we got on Thursday, I guess it was from July. So we're going to have a whole new number coming up in September here I guess a couple weeks. I think it's going to be, October. No, September. I think it's in like a week or two for the August number. So we're going to get that August number, and it's going to look a lot different, I think, from what we saw in July, just where given what's transpired across commodity complex in the last month or so. So that really drives home the higher for longer, and the fact that we remain in that camp. We continue to see a quad 4 environment in Q4, and then back-to-back quad 3s, I believe it is. And let me just double check that from the most recent data. But so quad 4 to Q4, and then quad 3s in Q1 and Q2. The interesting call out here in regards to something that changed over the course of the last 2 weeks from the last notebook review is that Q3 here in 23 is now in the nowcast model a quad 1 with a little over a 50.7% conditional probability, and quad 4 moving down to 35.3% probability. So again, that has changed. So if we see this kind of continue to roll out in the rest of this quarter, the rest of this month, remains intact in regards to where the growth and inflation numbers, what we're forecasting are coming in. We're actually going to start the year in 23 with 3 quad 1s, and then moving to a quad 4 environment in Q4 of this year. So again, this is Jonesy mentioned it on the macro show this morning in regards to a big GDP number, which the Atlanta Fed is certainly forecasting, which is up north of 5.5%. We're currently sitting at about 4.25 on a QSAR projection standpoint. That just means you got a massive comp, the following quarter, and you can see what was looking like kind of a bit more of a sort of shallow quad 4 it could potentially turn into a bit more of a deeper quad 4. Now again, time will tell, and the numbers, as we get the numbers, our data and nowcast model will continue to update, but just wanted to call that out since it was something new on the board from 2 weeks ago. All right. So we've gone over a few dollar volatility, rates environment, our nowcast model, kind of hit on the main things that I wanted to touch base on. I think, I guess lastly, and I did tweet this out in terms of some of the data that was coming out of Europe, that data just continues to weaken. So European recessionary environment, it continues to be I think you're seeing it kind of roll over in regards to whether it be the DAX or the FTSE, the CAC 40, even the FTSE and the FSXE, which would be the Stocks 50 index. That's all starting to roll over here and is trying, or looks like it. Certainly the FSXE is trying to put in new 1 month and 3 month lows. Now that happened about 2 weeks ago, on the 18th is the official low, but we are basically right above that number. So keep an eye on that. And I think if you do see some continued weakness there and or strengthening dollar, weaker euro, there could be a lot further down and a lot more downside risk to those equity environments and markets themselves. I think that's probably some of the best shorts on the boards at the moment would be within Europe, and continuing to stay with the Chinese shorts as well, and remaining with our long Japan and long India exposures. So this is, so just kind of wanted to touch base quickly on a little bit of the global markets as well. If anybody want to jump up, I think I did ask, I don't know if it went through. I was having some, hey, other side just joined X2, a little 1,000 hour FX coming in from the UK. Bozeman, my man, I gotta just invite a lot of people up. Let's just see what happens. Let's get a conversation rolling. Are my invites going through to you? Give me a thumbs up or a thumbs down. Or you can just invite. There we go. X2's requesting the chat. X2, how you doing?
What's up, Robert?
Good.
How you doing?
Good. I'm great. So sorry, X2. Other side, Tim. Loftus. I did invite you, so maybe there's something happening with Twitter at the moment. But yeah, if you guys want to jump up and chat, by all means, just request to speak, and we will make that happen. X2, how you doing, man? Back to you.
Good. I heard you talking about the dollar.
Yeah, sorry, I was just having a little water. Yes, sir, the dollar.
Trade.
Yeah, it's been a great trade, and I know you love trading the euro. X2?
I've been having some issues. I've been having some issues too, Robert. I've been on and off.
Oh, really? Weird. Okay. Can you hear me okay, though, other side?
Yeah, I can hear you fine. It's just been bouncing me on and off. I don't know why.
I don't know. Maybe it's the man, the overlord. The overlord is out to get you.
I'm sure my account's probably shadow banned in a handful of different places, so it very well could.
So how you doing, man? You haven't been on in a while, other side. So just wanted to, I guess you probably. Well, I know you just you published your monthly last week, which we love to remind everybody to go read because it's a fantastic piece of writing. But how are you kind of navigating these markets for your clients these days?
I'm still being cautious. I'm trying to be patient as well. I have published the monthly. I have a lot of cash, or when I say a lot of cash, a lot of short-term items, clipping 5% roughly. I do have a little bit of the, I haven't been on in a long time, so I don't know what you guys have talked about, but I do own a little bit of the tech that is green, and possibly for that quad 3 exposure, right? Your Googles, which have the pod 1 accelerations, the Googles that Keith's talked about, that are still green on the list. I do still have my gold position on, but it's small. I don't know. I've just been cautious. I think we're at an interesting spot right now with the gamma bands. Gamma being negative right now, heading into, a possible probable quad 4. I understand I understand what you just talked about in terms of a quad 1, with a quad 4 looming, and then a couple quad 3s in the background. The last year, we weren't expecting the quad 4 until Q2, and then January, end of December, January was a disaster. So these things can pull forward. I think anybody who listened to the Tier 1 Alpha conversation from yesterday, these exogenous shocks can happen, right? So while I don't know when it happens, my guess is most likely around a deterioration in labor, as you, myself, and Thousand Air FX have discussed the passive bid being around the labor markets, and as people fall out of labor markets and can't really participate in their 401ks, you see a correlation to equity market sell-offs or significant equity market sell-offs. I think I put that in a monthly like 3+ months ago. So, I'm still playing it from the passive bid side exists, but at the same time, the labor market is deteriorating. My last note talked about the labor market deteriorating much more rapidly than advertised, right? 585,000 full-time jobs lost June over July. And and they were replaced by 900 plus thousand part-time jobs with 118,000 multiple working jobs. So it's one of those things where that those who have full-time jobs have a higher income, consume more. It's fairly straightforward, and you're getting multiple jobs because you can't make ends meet. And I've had a handful of conversations with clients, some of them saying, that's me, right? A teacher client of mine said, that's me. That's literally me and most of my friends. As I described it to her, as she's looking to buy a house, and her, from her current renting, she can't afford double in what she would be paying. So it's hitting the consumer. It's hitting the consumer hard. It's just bleeding through. You just have to look for it. I put you to sleep?
No. It's just sad.
It's sad. I mean, but still make money in markets can go up, right? Market go up, right? You could still have markets up on this passive bid, and everybody's wondering why, why hasn't it collapsed? And well, you still have the passive bid, but eventually that passive bid gives way as people get fired, and the more people get fired, the more people need money. I think in that same note, I talked about the number of people who are now taking emergency funds from their 401ks.
Yeah,
I think it's up like
they changed that
6%.
They changed that ruling, I think, right? The government did. You can borrow. What's that? Maybe not change, but I think they increased the dollar amount, right? Because you can take out like $1,000 or $3,000, I think, a year as a special kind of like loan. I'm butchering what it's actually called, but
yeah, I think so. At the same time, that's less what they're doing, more just taking more money, borrowing against their 401k because they need the money, right? So I think the number was up 36% year over year, I think it was, which it's not a huge number from the standpoint of 16,000 versus the pool of 401ks that exist. But as every Hedgeye guy knows, gal, right? As we all know, it's not about the level, it's about the rate of change. So more and more people are pilfering their 401ks because they don't have money, right? Student loan thing coming online in a handful of weeks. So it's all what Hedgeye's talked about regarding the consumer. The question mark becomes, the market dynamics currently. And, we see that through the passive investing, and we see that through the gamma and through the options markets and the zero DTEs. So now it becomes an exercise in risk managing until you have some type of exogenous shock. And I don't know when it is, but when you have this many companies that need to refinance at rates where they currently are, you're going to have a problem in the future. How near or far, I don't know. So we're just going to play it with our trailing stops, capital preservation strategies, and go from there.
Yeah, appreciate it. Thanks, other side. And very wise words as usual. Loftus, how you doing?
Yep.
Yeah, I can. Awesome. Thanks for jumping up.
Sure. This is better than 8 o'clock at night. I'm winding down at that point after probably playing a little bit of golf and
yeah.
So, So let me, listen to Mitchell. I guess a couple things. One, I live in a beach community in Delaware. Okay, and so over the last 4 or 5 weeks, I've just been getting out, talking to people, and seeing people at my liquor store where I get all my stuff. Way off. Like everyone is buying down. I like bourbon. I collect a lot of bourbon. Like nobody's buying the high end stuff anymore. I've got a client who owns a restaurant. Way off. Okay. Where I take my boat, there's this little place, a little restaurant I go to. 30% people there on a Sunday afternoon when it's 85 and sunny. Right next to that is a park for campers and things like that. And it's always mobbed. And this year, like the front row, which is kind of, the higher end row, there's 15 premium spots. I've been seeing 5 taken a week. So that just tells you what's really happening with the consumer. I mean, there's no doubt that it's out there. And I think that, we talked about it. I'm sure we'll hear about it on Keith's call Friday. The lag effect of these interest rate hikes are really starting to hit. There's no doubt about it. And then, of course, you've got the loans, right? I've got some student loans for my kids. I had 3 kids in college last year. Y'all can imagine what that costs. And it's a big number to, my monthly, again, I'm able to handle it, but I'm just saying it's going to be interesting to see what happens. I saw an article the other day, 45% of the people that are going to restart the loans think they're going to default. So I think that's number one, right? This whole facade that the consumer is strong is just not there. And I don't see it at all in this community. We saw people here this summer. Oh, and the other thing is I've got a client that runs the number one rental shop here at Big Firm, off 30% year over year. So there's just so much, that's just being here, looking around and seeing what's happening. And then we can, of course, look at all the data we've got, in the last week with PCE and consumer confidence and, et cetera, et cetera. So I think for me, very similar. I'm still pretty conservative. I look at my model right now. I've got 22% in FDR XX. Then I've got ultra short bond funds that are paying 5.25 to 5.7. That's another 25%. My largest holdings right now is oil. I broke that up. As an advisor, clients hate K1s. So I did not buy USO or UGA because I just didn't want to deal with that. I did buy, if anyone's looking for something without a K1, PDBC. It's an Invesco diversified commodity strategy, which has done nice. I have XLP, XLE, XOP. I also bought Oxy, OXY, Occidental, which has done really well. We're not all getting hit a little bit today. So that's really, and of course uranium, which I just wish I had more of that. I've got just a couple inverses on right now, which are RWM and SJB. You mentioned that about credit. Now, that's one thing maybe someone else can jump in on this. I am really surprised that the credit market just not been affected yet. Like what's happening, the spreads are just not there. You would think at this point, everything you're hearing, bankruptcies today, right? Biggest jump in history in August on bankruptcies with corporations. Why is that not?
So Mike, what you have to remember is the vast majority of the bonds are held by passive as well, right? So when people are wondering what's going on in the credit markets are still deteriorating, but the passive holders are still holding on to it. Go back to, circa 2017, 2018, when Toys R Us couldn't get funding and they went from 96 cents on the dollar to 26 cents on the dollar in 24 to 36 hours, right? So you're not going to see it in credit. I mean, you'll see it slowly, but you're not going to see it in credit until you start to have a handful of these downgrades from triple B to double B, in which case it's going to force some of these passives to sell. A la 2020 when Ford was downgraded and the entire market blew up. And that's when the Fed started buying junk bonds, backdating it 2 weeks. I've said this story numerous times. They backdated it 2 weeks, which happened to be 2 days before Ford was downgraded because the market couldn't absorb 250 billion. When I say the market, the high yield market couldn't absorb 250 billion of debt. It was only a $1.1 trillion market at the time. So again, these passive flows these passive holdings, these, HYGs or JNKs, they are much more subject to these exogenous events like Mike Green talks about as the, how can I phrase it? It's more of a structural scenario. And until we see that structural event and those downgrades, you probably aren't going to see what we think should happen, in my opinion.
No, I mean, I would agree with everything you said. I'm just surprised it hasn't happened. You know what I mean? You keep seeing it. So, I think, as Keith says, right, risk happens, a little bit and it all at once. So I think that's what we're going to see.
Yeah, I agree with you. I agree with you there.
Hey, Mitch, this is John Pastillier. How you doing? Hey, I think your discussion and your explanation of, the high credit, high yield market was phenomenal. I mean, I made a lot of money in that in '08, and I sat on it for freaking ever. And then the payout literally happened in weeks. So we're sitting here with SJB as well at a 3% position, but man, I'm dying to take that into a real meaningful position. But nice job, Mitch. That was a good description.
I appreciate it, John. I mean, so years ago, and I'm talking years ago, 2018, I wrote about the passive scenario in passive bond markets, and I called it, the piece that I wrote, I called Moab, Mother of All Bombs, not Mother of All Bubbles like Keith does. And the reality is if you look at the structure of how these things are made, they're made based upon creation units and redemption units. So isn't actually the under.
Hey, Mitchell, I think we lost you there for a minute. Yeah. At least the ding went off, so we know he buckled up before he hit the road. But I'm sure he'll come back. He's probably just in the dead zone. Pastilli, why don't listen, I know you own a ton, or I won't say a ton, but you are you have a big opportunity in the precious metal space, and kind of certainly have taken advantage of that since November when we made the pivot here at Hedgeye. So how have you been playing, or kind of what kind of decisions have you been making in the last, call it, I guess, like really month and a half, in terms of, this sort of recent, pullback? We, from Keith's perspective and our perspective, we call it kind of certainly a buying opportunity, but not, not all at once, and not at any price either. So just kind of curious kind of how you've been navigating that with your clients.
Yeah, sure. So for me anyway, I've been very tame when it comes to gold and miners and silver. Right now, we're at about a 4% allocation to gold, 0 to silver, and 2.5, 3 to miners. So historically, when we get involved in gold, we've done it in a very big way. And one of the things I was telling Jonesy when we were out there in Connecticut was, I truly appreciate those risk ranges because it allows me to be a lot more tactical and frankly make more money by trading it. So right now we're fairly minimal in our positioning. The good old days prior to Hedgeye, I would take that sector to 70, 80% at times. So being as small as we are has worked, right? Because it really hasn't done much here, call the last month and a half. It's kind of gone up and down across its risk ranges. And that's all we've done. We played the risk ranges on it. Now, having said all that, I think the setup is going to be spectacular. I'm getting real antsy to really buy a lot of gold. And what I'm waiting for, frankly, is a 10-year to hit the top end of its range. And the minute I see that, I'll go from, 4 to 10 in a hurry. So historically, quad threes have been incredible for gold. That's literally where I've made my entire net worth is is playing quad 3 gold in a big way. And I think that setup is dead ahead of us. So I'm watching it very carefully. I'm using those risk ranges a lot more aggressively. And what I'm starting to do now, guys, is rather than, go up and down by half a point or 1%, I'm getting a lot larger in my trades. So when it hits the bottom end, or when the 10-year hits, if and when it hits the top end of its yield range and the risk range, and gold more than likely will be, well, it's almost there now, the bottom end of its range. I'll quickly go from 4 to 10 instead of 4 to 4.5 to 5 to 5.25. What I'm finding is we got to get a lot more aggressive in positioning and putting real money to work, and then quickly taking it out when you start going back down from the top end of the range. So that's what we're doing. I mean, I wouldn't be surprised at some point if I've got 15 to 20% in the sector, and especially as we get closer to this quad 3 setup. Oh my God, it's going to be interesting. If you're one of these money guys and you're worried about the dollar, crypto's pretty much in the penalty house. What are you going to do? I mean, there's really not many places to go here. You can short the markets, but at some point, folks are going to need an alternative to financial assets. And gold's still hated. It's always hated, it seems like. And it's fairly underowned. And the rest of the world is pivoting to gold in a really big way. So the physical demand is off the charts. If you physically try to go buy gold, you're going to find that even in the US, it's fairly tight. Inventories are tight. Premiums, last I checked, were crazy high. They probably come down a little since. That was probably about 2 months ago I checked. So anyway, so that's kind of us in gold. But right now, frankly, we're really, sorry, go ahead.
I apologize. I think I got cut off in terms of my my speaker went out. But in terms of gold, and I'm not questioning the back test. I'm more so asking a question. Why gold? Why does gold, or why do you think gold performs well in quad 3 when in quad 3 rates still move higher?
Because you got growth decelerating and you got inflation rising. So it's a perfect setup for owning the metal, right? So if your inflation is rising, that's usually a negative indicator on your currency.
Right.
And when GDP declines and that inflation spikes, I mean, that's really the caveat to making gold run. And if you notice, the gold-dollar relationship is kind of pivoted, is turned. So that's out of the way. So really, the only game left to keeping gold from going totally nuts is rates, to your point, right? But you get to a point where gold doesn't care about rates or the dollar. It just goes. And that's what quad 3, that's usually where I see it, is in quad 3.
Thank you.
So I was making the other comment that in terms of our overall allocation, we're incredibly defensive. So right now we probably have 70% in short-term T-bills, so you're getting that 5+ yield. We've got index shorts with all 3 indices as well as SJB. So that's probably another 10-ish% of what we got. And we're only long, really small sectors, right? Oil, gold, India, Japan, UUP, the dollar, and that's about. So on a day like this, we're barely moving.
Yeah, and I think, and Mitchell, I mean, one of the other things too is if you look at like real rates, so gold and real, like, so gold has basically an 80% inverse correlation to real rates. And so from this move that we've seen for November of 2022, we basically are flat on real rates. I mean, we got from, again, just like in terms of like where we started, in terms of where gold started picking up steam, was basically real rates were trading about 1.8. And then we're basically we're at 1.79. Well, technically it's 1.81, and we're at 1.79 as of yesterday's closing prices. And gold has gone from just above 1,700 at that point to where we are today around, or where it closed yesterday around, call it 1945 or so. So I think that's a big thing, and in that environment, on the big run up, we basically, up until most recently, kind of call it July, real rates had dropped all the way down to, 1.2-ish range, 1.2, call it 1.22. So there was a, what was a 50-ish delta there, 55, percent delta on the interest rate, which on the real rates, which does really help buoy that the gold price. And if you kind of and if you go back, so if you go back to more of like stagflation, or sorry, to that quad 3 environment where what we had, I think it was back in, what was it? That was 2020. I think it was, wasn't it? Facility where we had, 2020. Yep. You kind of saw a similar construct occur where you had, real rates at that time were negative, but they dropped from, negative 0.4 down to negative, negative 4, negative 1. And that was that, and that had that pretty big run up in, that was 2021. I wasn't 2020. Similar basically thing. But basically the real rates environment and the real rates in tracking that really does help in conjunction, obviously, with the risk ranges.
That's a really good point. The real rates are what do it. But Mitchell, what I was really describing is when you get to the mania phase. So when gold, the psychology in gold is phenomenal in that it's the only asset that moves based on fear and greed. And by that, I mean, gold really goes nuts when you start getting real nervous about the system, right? You start getting real nervous about stocks, right? Bonds. So gold, when it really takes off, it's because you're buying it because you're fearful of the system and you want a different asset class that's effectively outside the system. And then that price move brings in the momentum players, the greed guys, right? And so that's why those gold bull markets are so powerful, the mania side of it, because you're coming at it from fear, which is a stronger emotion, and greed.
That makes sense. Thank you.
Mitchell, do you want to finish off your commentary on the high yield side of things before we lost you to the dead zone that is central? If you want to tell me,
if you want to tell me where I left off, because I literally think I was talking for 2 minutes and I came back and I'm like, I didn't hear what I said.
We did not.
Where'd I leave?
Basically, once you put on your seatbelt and the dinging stopped.
Forget about. Tell me exactly what I said.
I don't know, dude. It was hard to hear you over the dinging. So, no, you were talking. You were talking about. What were you talking about? You were talking about. Pistilli mentioned how your summary was very good, and then you were going to expand on that in terms of. I think we were talking. Pistilli, help me out here. He was mentioning. Do you remember what he was saying?
Well, he was mentioning the high yield. No, he was mentioning the high yield.
Well, I think. Oh, forward bonds and the passive holders. Thank you, X2. Yeah, I think what I was trying to get to, or what I was alluding to when I cut out, was understanding exactly how these ETFs are structured and how they trade. So in many cases, the underlying bonds aren't even traded. So what the redemption, the creation units and redemption units of an ETF are typically what trade back and forth. And it's almost like trading paper to an extent, where the underlying of the bonds don't even need to be traded until the redemption units outweigh the creation units, in which case then the underlying needs to be sold. So you could have, you could basically have paper trading back and forth without needing to sell an actual bond itself. But what I was also alluding to is that when you get to that situation or to that point where the creation units or the redemption units outweigh the creation units and the underlying actually has to be sold, you can have scenarios where 10% of those portfolios by prospectus are in illiquid securities, and illiquid securities are defined as securities which cannot be sold or liquidated in under 7 days without severely adversely affecting the price of the bond. So the product claims instant liquidity based upon, again, the structure in these creation and redemption units. But when the shit hits the fan and you have more redemption units, you then have to liquidate the underlying. And in many cases, unless you get through, like once you get through the top 30 bonds that are actually liquid, the liquidity just dries up, and X2 can talk to liquidity in bond markets, right? So, you know, you can have things that don't trade for ages and they need to be sold for the liquidity, but there is no liquidity there. So that's why you can have these vacuums of these things sucked down all at one time. So where John is working through this, and why hasn't it happened? And, you know, Michael as well, you know, it's the all at once happens again because of structure. When these investments, when the underlying securities and bonds in these investments need to be sold, you can't find the buyers, and then you have that massive drop, which again is just like the Ford bond being downgraded from BBB to BB, right? That fallen angel being so important and critical because everybody who owns that Ford bond from an institutional level that by prospectus can only own investment grade paper then needs to sell it. And you can't unload $250 billion of that Ford bond back in 2020 into a market that's only 1.1 trillion in size. 20% of the market can't, your entire market can't be absorbed, or 20% of the market can't absorb that one bond without things getting absolutely smoked. The money just doesn't exist in that market unless it goes off to, you know, private equity that has funds set up specifically designed for that. And still they have, buying parameters that they can't go over certain limits, right? So it goes back similarly how we're talking market structure in terms of why markets are going up and, you know, the ODTEs and the impact that has. Market structure on the passive bond markets, in my opinion, is and has always been more scary, which is why we wrote that note in 2018. And nobody paid any mind to it. But it's exactly what happened in 2020, exactly to a T.
Literally, Mitch, all it would take is for either AT&T, GE, or Ford to get downgraded, and decently downgraded.
Those three names are three names that I listed in that 2018 note, John.
Yeah, exactly. I mean, those are the big boys in the room, right? And so I watch AT&T pretty closely. It's like, man, if this thing goes, everything goes.
Yeah, but and they're not the only ones. They're like 7 to 10. But even you just need a collective, right? I mean, if back then, back in 2020, if my memory serves, you had, I want to say the kind of updated warning note that I put out before the crash. You had bond market was about 6.5 trillion. The BBB level was hanging around 3 to 3.5. So you had nearly half the bond market sitting on that line, sitting on the BBB line. And you can't tell me for 1 second that these banks out there, that these, banks, that these autos, that you can't tell me that with the consumer in the shape that they're in. I mean, how do you have, as Moody's and Fitch, how do you downgrade 7 banks when you got regional banks out there that are all in the same boat, that are worse off today than they were before? And now they're taking loans from the BTFD program, which need to be paid back, and they're at high interest rates. I mean, it's just, you're literally looking at, and I don't want to say you're looking at an 08, 09 or an 07, 08, 09 scenario, but you're looking at a scenario where the ratings agencies are complicit in this, where they're not doing what they need to do based upon the data that exists, in my opinion. It's not even close.
All right, awesome. Thanks for just getting that final thought out there, Mitchell. I appreciate it, buddy. It was good. I just want to complete the loop there because I think it's crucial, and it's a crucial component. And Loftus, it was a great call out in terms of just high yield and what it's doing and how it's functioning, and all of the above, all the commentary is actually spot on. And I think just it remains a course short from a Hedgeye perspective, and it's in trading, to leverage kind of what Pasuli was saying, trading it in tranches within its risk range band, and you get that every day, both on a trend you get that on the trade durations, immediate term, and then on a trend duration within the ETF Pro. And I think both of those, leveraging both of those risk ranges and where they sit, how they overlay, and what have you, will give you a lot of ammo to make, to try to make, good decisions at the right time. In conjunction, and Pasili, in conjunction with, to your point, where, the yields are trading, right? So if you got kind of yields down at the low end of the risk range and high yield close to or above the top end of its risk range, then that's a great time to execute, or potentially execute.
I'll shut up. I'll shut up after this, Robert. It's exactly what it's what Hedgeye talks about, just with a slightly different slant. Keith talks about the machine. The passive indices are part of the machine. It's what Mike Green talks about and Tier 1 Alpha with the machine. And as he said yesterday, how can you possibly be saying this? We write it ourselves, as he said yesterday. We understand that this is very difficult to believe given the setup, right? But that's what the structure of passive investing has done. I mean, I was introduced to Mike in 2019, 2020-ish, but I wrote that piece before I knew who Mike was. And the few times that I've spoke with Mike beforehand, Mike was not doing a ton of work on the passive bond market. Subsequently, he has, and obviously his work is brilliant. So, but it's all the machine, but at the same time, where things happen slowly and then all at once, it happens all at once for a reason, because the system breaks. The system can't handle this. And my guess is we'll see it as these bonds need to be repriced, because bonds have a maturity and they can't just keep pushing things out. So where a loan can be extended, like MPW extended had their line extended a year or so ago, right? They had that line of credit extended. In this scenario, the bond market's not like that. A bond either matures and is paid off and reissued at a different rate level, or it's not. That's either, that's the difference between solvency and insolvency. It's the difference between a bond going bankrupt or not. So
Mitch, to your point again, I mean, think of how much debt in the last, call it half dozen years, has been issued as, 1%, 2%, 3%. That's unsustainable, right? So now these bonds are coming due and they're repricing at market rates. And a lot of these companies just are going to disappear. They can't make it work at 7 or 8 or 9.
Yeah.
So to me, I try to keep this as simple as possible. It's like we issued trillions of paper across all companies, individuals, whatever, at rates of almost zero. And to think that you could survive this when rates reprice, you got to be, kind of delusional.
Yeah. Yeah. So a different piece in 2018 that I wrote about, it was more so, if you did this in stages, right? If this was done in stages, then you'd have a much better chance. And when I say this, I mean when the Fed held rates at zero, if you had a handful of companies that refinanced at zero and bonds were issued at zero for a year and a half, 2 years, cool, no harm, no foul. What we talked about back in 2017, 2018 is the length of time that the Fed held rates at zero literally allowed everybody from their mother, brother, municipality, federal governments, local governments, states, everybody refinanced at those low levels, right? Sovereign governments. I mean, at the time we were joking about how anybody would issue Argentina a century bond when they went bankrupt 9 times in the last 56 years. I mean, it allowed everybody to refinance at near dirt cheap levels, right? So now you've come across a scenario where I think the scenario that we used back then was, if you actually took that money and used that money to build something which would generate a much greater revenue stream, then you're okay. But that's not what people did. People took a $20,000 loan. For example, we use this simple interest. $20,000 at 1%, is what? Think about the interest rate on it. I think what it worked out to was 20,000. You could borrow $100,000 at 1%, like you could 20,000 at 4% or 5%, right? It was the same $1,000 payment, right? So people would just go out and buy a car or go out and buy something that did absolutely no good to generate revenue, but at the end of the day, they put 5 times the amount of leverage on their books. And that's what we're looking at. We're looking at an over-leveraged society that's exponentially worse off than we were 4.5, 5 years ago. And now people are choking on this cost of capital. And like Mike Green pointed out, 93% of the companies in the high-yield space, if forced to refinance between now and 2025 or 2024, would be bankrupt, cash flow negative, right? So, right now they're solvent, but if they have to reprice at 12 to 13%, they're done because they borrowed at 4 to 5%, but they can't afford 12 to 13%, which is where rates are now.
Yeah, we got the worst of both worlds, Mitch, because we've got people have maxed out the amount of borrowings, and now the cost of that borrowing is going up exponentially.
Correct. I mean, I saw an article, and I've been on the Stansberry Investor Hour podcast a couple times, so I have respect for the Stansberry guys. But one of their guys, I can't remember who it was, but he wrote a piece that talked about credit being the amount of credit or the amount of money on a credit card in today's world in excess of $1 trillion is a good thing because the millennials think they can afford it. And I'm literally reading this, pulling out my hair, going, "You got to be kidding me." I mean, it's one of the most irresponsible pieces I've read, and I can't tell you how long. If they could afford it, they would have paid it down in the first quarter. If they could afford it, you wouldn't have 50, 60% of people not able to afford a $400 emergency, or I think it's now 46% are comfortable, or I can't remember the number off the top of my head, but I wrote it in one of my notes.
Hey, Mitch, listen to this story, though. About a year ago, the Interactive Broker guys were trying to talk to us into moving our book of business over to them. And one of the things he was telling us to entice us to do it, he said, listen, our margin rates are sub 1%. We have clients that are pulling $1 million, $2 million off their portfolios and buying homes with it because the interest rate's so low. And I was like, oh my God, seriously? Can you imagine a margin call on your house in the middle of a market crash? What a beautiful way to mismanage your net worth.
So you and I could talk about this literally all day. It's probably not what everybody on here wants to chat about, but I mean, it's a scenario that I don't see a good outcome. I don't see how. I don't know what they're trying to do, what the powers to be are trying to do. I don't know if they're trying, I don't want to get conspiratorial. I don't know if they're trying to crash a system. I don't know if they're trying to go to digital currency. I have no idea what they're trying to do, but they can't be this dumb. I don't know if they're just going to change, give people access, give everybody and their mother access to cheap loans, and then, watch everything, balloon again in terms of, inflation just through the roof. They're literally painted into a corner as can be painted into a corner, because whatever they do, it's a bad outcome. in the way I see it maneuvering. Now, if they do give everybody cheap loans, well, we know how to position our books. It's all in, right? I mean, if they're just going to give everybody cheap loans and throw trillions at the markets, well, asset prices are going to inflate, inflation's back, and the people are screwed again. So if they don't and they really fight it, and we're going to have mass bankruptcies all over the place, unemployment through the roof, and it wouldn't be the worst thing in the world, because ultimately, at the end of the day, you need a default cycle, just like forest fires need to burn in order to create new growth, right? You need it, but it's going to be a painful time period. You can't do this without some pain somewhere. I just don't know how they fix it and how quickly they fix it.
I don't know. Now you got Mother Nature, and now we're going to get shadow banned by by global warming side of Twitter too, Mitchell. We need to comment on forest fires. On that note, I'll everybody who's listening. But speaking of inflation and commodities, one of the reasons many reasons why I wanted to bring Tim up here was because of his excellent and one of the beauties of Hedgeye Nation is that we have folks from kind of all over the country, the world, all different sorts of fields, whether it's running their own business or working within a certain sector, et cetera, et cetera. And so Tim, I don't know if you can chat right now, but if we can, I'd love to just get sort of a bit of a boots on the ground, a view from you in terms of what's transpiring in the oil and gas arena. Yeah, sure. Welcome.
I'd be happy to share. Yes, in the broader market, it's kind of interesting to me that so many things, because we bounced around so much, have clustered so close. I was counting up as we were talking here the number of things on my pin sheet where the trade and trend have closed, and even we've crossed both together today, which is kind of an interesting call out. That's not about oil and gas, but on the oil and gas front, what I've been seeing is really on the service side. A few weeks ago I talked about how the wireline part of our business was suffering, and the same thing happened about 2 weeks ago now to us on the frac side. There's a kind of a general attitude in the industry that next year is going to be okay, and everybody's budgets are going to reset, and we're going to start spending again. But there's a lot of people whose budgets are run out, or they just want to delay a project, and there's a lot of space on frac calendars coming open. And there's horsepower prices have been taking a nosedive. Now you wouldn't know it looking at OIH or XLE or XOP or any of those things that's not getting baked in at all, because the crude price continues to rally. But if you look at the natural gas pricing, it doesn't look so great, at least in the near term. And you see that even on the trend signal. We've gone from bullish to neutral to bearish to, I don't know where it was this morning, but it looks bearish to me on the sheet on the screen right now. So that's kind of the short version of what's going on in oilfield service land. Is there's some near term pain, and if pricing doesn't stabilize and activity doesn't stabilize, there's going to be medium term pain. We continue to drop rigs, and the fundamentals, which don't really matter, we know in these markets on the short term, continue to be incredibly constructive if you just ignore the fact that Saudi Arabia is holding back 2 million barrels a day of capacity. So if we're seeing global inventories continue to fall, and now Russia's even playing along because it's in their best interest to get oil prices up, and they're constraining capacity. Now you have some guys in the industry arguing that because of lack of investment and lack of Western technology, their capacity is diminished. But whatever the cause, they're holding back capacity. So that's kind of the short version from oil land over here in the great state of Texas.
I appreciate that, Tim. No, it's a great update, and always a pleasure. Always great to have your insights. So we've just passed up kind of a little over the hour mark here. Love to kind of open it up to anybody out in the crowd. If you guys got any questions or comments, please feel free to jump up. Otherwise, we may just sort of wrap this thing up, but don't let that stop you. We got some great power users of the Hedgeye process, and just really excellent investors generally in terms of who's up here speaking. So, by all means, come on up and ask them any questions. I've I guess I've got a couple for the panel as folks as folks maybe muster the courage to request to speak. So we're going into, I guess here from an advisory standpoint, and Tim, I'm going to ask you kind of more because I know you more so manage your own personal money like I did while working. But so how do you guys? So Michael, other side, John, how do you guys navigate how do you work to navigate the sort of shorter term along with the kind of client expectations of obviously more of like the longer term goals, right? So just to use our I guess like the nowcast from Hedgeye perspective, where we've got going in to forecasting a quad 4 here in Q4 and then back-to-back quad 3s to start 2024. How does that kind of I guess that forecast start influence either your conversations with your clients or navigating the portfolios within your own books of business? Well, John, I'm going to go to you first at forecast. Or I guess you're on mute if you aren't. I can unmute you.
There we go. Sorry about that. Yeah. I'll be quite candid. I live in the present. It's taken me a long time to do that. So, the fact that there's 2 potential quad 3s in the first half of next year makes me incredibly bullish on gold, like I talked about earlier, but I'm still managing it with the risk ranges. So I'm trying to work really hard to get my emotions out and live in the present and trade accordingly. So
yeah, and how
sorry about that.
No, you're good. How long would you say that kind of took?
Hold on.
That. Oh, sorry. You got me?
Sorry about that. Can you guys hear me?
Yep, got you. Got you loud and clear.
Sorry. Yep. Okay. Yeah. So anyway, that's what I was going to say. From my perspective, our clients are pretty much hands off, right? We just manage the money.
Yeah.
But there's 2 things that we're changing. One is live in the present. Number 2 is start changing the size of the trades. So I know like Keith will hit it a bunch of times in a day or a week. I want to hit it more aggressively on either side of those risk ranges and get a little bigger initially to try to make more money while you kind of play this back and forth game.
Yep. And how long would you say it kind of is taking you to get to that point? Just like, again, ballpark.
Well, literally, frankly, in the last 3-4 weeks, Jason and I, my partner, we sat down and said, listen, because when we're right, we want to make a lot more money, right? And so the risk management side of it works fine. We get out quickly enough to try to avoid, major drawdowns or decent drawdowns. But on the flip side, we got to get aggressive on those endpoints, on those risk ranges, and just wait to see how the quads play out over the next coming quarters.
Yeah,
I mean, ideally, I'd love to go. 30% gold, 30% short, 40% cash, and call it good. That's how I used to do it, 7-10 years ago. And it worked. I made a lot of money, but I also didn't sleep a lot, right? I mean, I didn't sleep because every day was like, holy shit,
Yeah, it's a concentrated book, for sure.
Yeah, with Hedgeye, I mean, I sleep like a baby. It's an awesome way to manage wealth.
Yeah. Yeah, no, I think, just to echo your point, I mean, getting to that max sizing when applicable, right? And I think that's the biggest thing is like the timing does matter and executing at the fringes of the risk range. We say it time and time again. I think that's, we can get comfortable there and having a little bit of extra, like a little bit of patience and understanding that, again, there's lots of commentary around that across the board, but awesome, John. I appreciate that.
And actually, the other thing that we're doing more of is focusing on stuff that's just about to transition from bearish to bullish or vice versa, and try to take advantage of those as well. So if we can do that more aggressively, play the risk ranges more aggressively, and live in the present moment, that's how we've really changed our process here in the last, call it, month or two.
Awesome. That's super cool. Thank you for sharing that. Yeah, Tim, kind of same. How are you kind of managing it on your pool capital, bud?
Kind of what I've done since early summer when I really all this whole spring, as it went the opposite direction we kind of thought it was going to go, and just relentless rallies. You just keep sizing down. If it's not working, stop doing it. Is the moral of the story. And so that's kind of where I'm at now. Is I'm playing smaller, still playing ranges. I'm still looking for where's the good spot, where's the good entry, where's the good exit. Using all the tools that Hedgeye brings to the table, and gazing longingly at charts and doing all the other things that we all do. But it's really about position sizing and trying to figure out where overall is my total book. Am I 50% gross? Am I last year I would have been 100% gross on a cash basis and 200% on an options adjusted delta basis. But this year you just can't do that unless you're gonna go long on certain assets, but certainly not play the way we played last year. So it's been a big shift in the way that I play the book, and it's still playing the ranges, but it's playing with different position sizing and just being more conservative because all the things that make sense that you would want to have happen. You heard Cheese talk about it on the webcast yesterday. They don't work the way we thought they worked because of all these structural issues in the market. And so as we adjust to that, it changes the way we trade.
Yeah, 100%. And yeah, it's great. And it's great to hear. I don't know if Mitchell's still around, but if you are, oh, there you go. Perfect. Yeah, we're around. So same question to you, bud. How are you kind of navigating the short term with the longer term outlook?
Well, you and I have talked offline. I'm trying to. I know you can't always adjust based upon clients, but Michael, I think it was Michael that talked about clients not liking K1s and clients not liking, so many trades. So what we're trying to do these days is we're trying to focus more on the trend than the shorter term trade trades. So we're trying to let the litters come in just stay our rules in terms of losers before they become problematic. So if we can catch some trends, we can catch a nice run and just be in something for a while and not have to think about it. And if it does break a trend line, we'll cut it because those trend lines do always move up, right? They move higher. So as the trend line moves higher, it almost acts as a trailing stop. And then as we get towards scenarios like the quads, if we are near a quad 4, then I'll just manage or mitigate that risk by holding more cash. And when I say cash at this point, if cash is going to pay me 5 and change %, why dabble in duration right now? Like I'll worry about trying to catch the downturn in yields when I see something confirm that they're headed down, right? But at this point in time, that's not where we are. So get 5% change, let us ride, and we'll just, as John said, play the game in the moment, right? So, we'll go there.
Yeah, brilliant. All right, Trillion, thanks for jumping up. Probably looks like you're kind of the only one who ventured up here, so we'll answer any questions you have, Trillion, and then we'll call it an afternoon.
Hey, well, thanks so much for having me up. As always, I appreciate everybody. Other side manager, Mitch, I subscribe to your email. That's a great read as well. And this is a question for, I guess, other side management as well as Tim. That was some great data there. I've kind of been noticing the same thing. I'll keep it short and sweet, not to hold you up there, Rob. So basically, Tim, I've been looking at the oil services companies for the past couple quarters, and yes, there is sustained revenues, but it's mostly due to backlogs kind of coming into the present in many cases. And with that being said, the interest rates to purchase or finance much of the equipment are obviously up substantially, as with anything to finance. So it kind of discourages, expansion of production. If you look at the Baker Hughes rig counts and that, it's all down. And as you alluded to there, various production cuts are not only propping up the short-term price action of crude, but obviously they're doing it because of the clear reduction in demand coming down the pipeline, no pun intended. Do you see this in the oil sector as well as the bond market plumbing issues that are starting to bubble to the surface, leading to a March 2020 event, as in like a sudden drawdown? And this combined with the contributors such as like the 0 days to expiration options, it just seems like a massive house of cards that continues to grow larger and larger every passing day. I was just curious to your thoughts, guys. Thanks so much.
Well, I'll touch on part of that. I'll try not to pontificate too broadly. But in the oil field space, when you're looking at the service side, you need to break it into manufacturers and true service companies. Guys that are out there pumping every day, that are burning their equipment up on horizontal wells and having to replace it. That's one bucket. That's super capital intensive. They may call it maintenance, CapEx, or OpEx. It just depends on what their accounting system is. Most of those guys, not all of them, but most of them fix their debt problem. And so they're not as levered as they were coming into 2020. That being said, there's still some of them that if you had a prolonged pricing downturn because the financial markets decided to dump oil on them, everybody realizes, oh my gosh, we're going to have a recession moment. That could be a problem for some of them. Not as many as coming into 2020 though, because a lot of that got cleaned up. On the manufacturing side, that's where you see the backlogs and some of that stuff coming out. And broadly, the equipment, when new equipment orders are still reasonably strong, mainly because a lot of people are upgrading to e-fleets, to natural gas powered fleets. There's a lot of equipment turnover, and a lot of this frac equipment gets consumed in the process of fracking. You can't run a frac pump forever if you're going to run sand through it. Eventually, it wears down, and all the internals have to be replaced. So after 10 years, you've essentially got a brand new pump. You've just bought it piece by piece. So that's the two caveats I throw out there in the oil field space. Now, whether that actually results in a market cataclysm, I'm not smart enough to know that. I generally would lean that way, but that's not a good short-term trading strategy at all. At least it hadn't been for me.
Yeah, Trillion. I mean, I think like Tim, he's neck deep in it, buddy. So as much as I would love to add my own 2 cents, I think that's, we'll just leave it at that. Did that help?
Yes, of course. No, thank you.
Sometimes you just kind of
all-encompassing explanation.
Be, right?
Yeah.
Just gonna be like, all right, that was a really fucking good answer.
Oh, that was better. Yeah,
I'm sure so.
Yeah. Yeah. I guess I'll just remain in the money market fund for now. But thank you.
Pleasure. All right. Well, thank you everybody. Tim, other side, John, and Michael for stepping up X2 as well. I know it was brief, but thanks. Well, we got Vegas. We got Vegas Regional, or the Hedgeye Regional in Vegas on Tuesday next week. So for anybody attending that, looking forward to seeing everybody at the Green Valley Ranch. That should be a lot of fun and another great opportunity to educate and get some phenomenal interaction with a number of the sector heads that are flying out, as well as myself and David Salem. We are hosting a dinner, just to plug that, on Tuesday night. So if you're interested, please reach out to support@hedgeye.com, and we'll get you hooked up with that dinner. For those that aren't making it to Las Vegas, we did just announce Chicago. So Chicago is happening on November 9th, I believe it is. 1 second. It's a Thursday. So Thursday, November 9th is our next Hedgeye Regional in Chicago. So mark that on your calendar, and if that's an easier destination for you to get to, what have you, by all means, we'd love to have you in Chicago as well. So with that, we'll wrap things up. Appreciate everybody's time. Enjoy your afternoon trading session here, and good luck out there.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.